Guys, on today's video, we're going to talk about how business owners can maximize the amount of money they can get from a bank. Let's cover the basic principles. The bank wants to give you as little money as possible for as much security as possible at the highest rate. And you want the most amount of money, you want to give as little security as possible, and you want the lowest cost. So there's already a conflict. So what are the three things that you need to do to maximize how much you get from the bank? The first thing that you need to do is you need to make sure you've got asset protection. So you need to make sure that you've got the right structures in place to divide your assets and protect your assets. And you only give the bank what they really need in order to get the loan across the line. The last thing you want to be doing is giving the bank more security than what they deserve. Now, the other thing you might want to consider is that not all the debt that the business has needs to sit in the same entity that's borrowing from the bank. In some cases, you can put some of that debt in other different structures and vehicles that are separate from the entities going for the bank loan. Now, this is all pretty important because all of this comes to affect your serviceability when the bank calculates it. The second thing that you need to do is you need to make sure that you layer debt in the right way at the right time. So let's think about it. You might have a bank loan that you're going after. You need asset finance, you need equipment finance, you need invoice financing. All these things are going to affect your serviceability with the bank, and the bank's going to look at the amount of liabilities that you have. So how you time these loans is important, whilst also making sure you don't break any of the loan terms with the bank. Now, the third thing is you need to make sure you don't cross-collateralize your loans with the bank. What do I mean by that? Well, let's suppose you've got some personal investment properties and you've got your business loan as well. The worst thing that can happen is if the bank takes all of that as one big security pool. So in effect, on your personal investment properties, the bank might be having not just the first mortgage, but also a second mortgage to kind of guarantee the business loan. Now, this is important for a key critical reason. Let's suppose, for example, the business gets in trouble and you need emergency funds. If the assets are cross-collateralized, it's going to be very hard for you to get a second mortgage loan. And that's why it's absolutely critical you avoid cross-collateralization where possible. And you can do this by going to two different banks for two different loans.